Welcome to our economy-focused channel. Today's video delves into a crucial topic that shapes the financial landscape of nations: fiscal policy. We're here to demystify the intricacies of fiscal policy, explaining how governments make strategic decisions about taxation, public spending, and debt management. Whether you're a seasoned economist or just beginning to explore the fascinating world of finance, this video is packed with valuable insights. We'll explore the economic impact of fiscal policy, debunk common myths, and provide you with the knowledge you need to understand its significance. So, grab your notepads and join us as we embark on an enlightening journey through the realm of fiscal policy. Don't forget to hit that subscribe button and ring the bell to stay informed about our latest updates. Get ready to boost your economic IQ in what you should know about fiscal policy. Let's get started. Let me tell you, what is fiscal policy? Fiscal policy is the government's way of using spending and tax strategies to impact the overall economy, including factors like demand for goods and services, employment, inflation, and economic growth. During a recession, the government can lower tax rates or increase spending to boost demand and stimulate economic activity. On the other hand, to tackle inflation, the government may raise rates or reduce spending to slow down the economy. Fiscal policy is different from monetary policy, which is handled by central bankers and not elected government officials. Understanding fiscal policy. Fiscal policy in the U.S. is based on British economist John Maynard Keynes's ideas. He believed that recessions happen due to insufficient consumer spending and business investment in demand. Governments can stabilize the economy by adjusting spending and tax policies. This was evident during the Great Depression, leading to the New Deal with massive public spending and social welfare programs. In Keynesian economics, aggregate demand drives economic growth, consisting of consumer spending, business investment, net government spending, and net exports. Variable private sector behavior. Keynesian economists argue that the private sector elements of aggregate demand are highly fluctuating and influenced by psychological and emotional factors, making it challenging to sustain economic growth consistently. Consumer and business sentiments, such as pessimism, fear, and uncertainty, can trigger economic recessions and depressions. Conversely, excessive enthusiasm in the public sector during prosperous times can result in an overheated economy and inflation. Nonetheless, Keynesians believe that the government can employ rational management of taxation and spending to offset the imbalances in private sector consumption and investment. By doing so, the government can work towards stabilizing the economy and mitigating its fluctuations. Corrective government fiscal action. In economic downturns, the government can use corrective fiscal action by increasing its spending and/or reducing taxes to boost overall demand. Conversely, when the private sector is overly optimistic and spends excessively on consumption and investments, the government can decrease spending and/or raise taxes to dampen demand. For economic stabilization, the government should implement expansionary fiscal policies, such as running large budget deficits during downturns. On the other hand, during periods of economic growth, contractionary fiscal policies, such as running budget surpluses, can be employed. Now let's talk about fiscal policy example. During the Great Depression of the 1930s, U.S. unemployment rose to 25% and millions stood in breadlines for food. The misery seemed endless. President Franklin D. Roosevelt decided to put an expansionary fiscal policy to work. He launched his New Deal soon after taking office. It created new government agencies, the WPA Jobs Program and the Social Security Program, which exists to this day. These spending efforts, combined with his continued expansionary policy spending during World War II, pulled the country out of the Depression. Let me show you the most interesting part of the video, which is about who handles fiscal policy. In the United States, fiscal policy is managed by both the executive and legislative branches. The President and the Secretary of the Treasury hold crucial roles in the executive branch, and they may seek advice from a council of economic advisors. On the other hand, the legislative branch, represented by the U.S. Congress, plays a vital role in fiscal policy. Congress has the authority to authorize taxes, pass laws, and allocate funds for fiscal measures through its power of the purse. This process involves the involvement, deliberation, and approval from both the House of Representatives and the Senate. Let's talk about how does fiscal policy affect people? Often, the effects of fiscal policy aren't felt equally by everyone. Depending on the political orientations and goals of the policymakers, a tax cut could affect only the middle class, which is typically the largest economic group. In times of economic decline and rising taxation, this same group may have to pay more taxes than the wealthier upper class. Similarly, when a government decides to adjust its spending, its policy may affect only a specific group of people. A decision to build a new bridge, for example, will give work and more income to hundreds of construction workers. A decision to spend money on building a new space shuttle, on the other hand, benefits only a small, specialized pool of experts and firms, which would not do much to increase aggregate employment levels. Should the government be getting involved with the economy? One of the biggest obstacles facing policymakers is deciding how much direct involvement the government should have in the economy and individuals' economic lives. Indeed, there have been various degrees of interference by the government over the history of the United States. For the most part, it is accepted that a certain degree of government involvement is necessary to sustain a vibrant economy on which the economic well-being of the population depends. Now we are going to talk about downside of expansionary policy. The expansionary fiscal policy, while aimed at stimulating economic growth, comes with several downsides and criticisms. Mounting deficits. One of the main criticisms is the concern about increasing government deficits. When expansionary policy leads to significant deficit spending, it can negatively impact economic growth in the long run and may necessitate harmful austerity measures later to control debt. Crowding out private investment. Some economists argue that increased government spending may crowd out private sector investment. As the government demands more resources, it can lead to higher interest rates and limited borrowing options for private businesses, potentially hindering their growth. Difficulty in reversal. Expansionary policies, once implemented, can be challenging to reverse. Even if they do not achieve the intended macroeconomic effects, such policies are politically popular, as they often involve lower taxes and increased public spending, making it difficult for policymakers to take necessary corrective actions. Bias towards deficit spending. Due to political incentives, there is a tendency for governments to engage in ongoing deficit spending, which is often justified as beneficial for the economy. This constant deficit spending can pose risks, such as inflation and asset bubbles. Inflation and asset bubbles. If the expansionary policy is not carefully managed, economic expansion can get out of control, leading to rising wages, inflation, and the formation of asset bubbles. When these bubbles burst, widespread defaults and economic damage can occur. Fiscal policy versus monetary policy. Fiscal policy and monetary policy are two distinct approaches used by the government and the central bank, respectively, to influence the economy. Fiscal policy, responsibility, handled by the government. Methods, involves using taxes and government spending to stimulate or control economic activity. Objective, aim to achieve economic goals like promoting growth, reducing unemployment, and controlling inflation through changes in government expenditure and taxation. Tools, adjusting tax rates and government spending levels. Monetary policy, responsibility, managed by the central bank, for example, the Federal Reserve in the U.S. Methods, focuses on regulating the money supply and interest rates to influence economic activity. Objective, aim to promote maximum employment, stable prices, and moderate long-term interest rates as directed by Congress. Tools, utilizes measures like open market operations, buying, selling securities, setting discount rates, controlling federal funds rates, establishing reserve requirements for banks, engaging in liquidity swaps, and conducting overnight repurchase agreements. Closing thought. The government's use of spending and tax strategies to impact the economy. We've explored its economic impact, debunked myths, and provided valuable insights for both seasoned economists and finance beginners. Fiscal policy stabilizes the economy by adjusting spending and taxes during recessions and periods of growth. Fiscal policy in the U.S. is based on economist John Maynard Keynes's ideas. The government can use corrective action to boost demand during downturns and dampen excessive spending during economic booms. In the past, expansionary fiscal policies like the New Deal helped pull the U.S. out of the Great Depression. Fiscal policy is managed by both the executive and legislative branches, and its effects aren't felt equally by everyone. There are downsides to expansionary policy, such as mounting deficits, crowding out private investment, and difficulty in reversal. Fiscal policy should be distinguished from monetary policy, which is handled by the central bank. Understanding fiscal policy is essential for navigating the economic landscape and making informed financial decisions. And that's a wrap on our exploration of fiscal policy. We hope you found this video informative and insightful. If you enjoyed this video and want to stay informed about all things economy, don't forget to give it a thumbs up and subscribe to our channel. We love hearing from you, so feel free to leave your thoughts and questions in the comments section below. Is there a specific economic topic you'd like us to cover next? Let us know, and we'll be more than happy to delve into it.